When we hear that Elon Musk is worth $300 billion, we already imagine him swimming in a vault of money like Scrooge McDuck. But the funny thing is, he might not even be able to buy a $10 billion company tomorrow if he wanted to. Not because he can't afford it, but because his wealth isn't what you think it is. In fact, the world's richest people often have surprisingly little actual cash. Some billionaires even have been forced to take out loans just to cover everyday expenses. A common belief is that wealth equals having tons of money under your belt. We see headlines about billionaires making billions in a day, so naturally we imagine them receiving massive deposits. But this common belief misses something fundamental about how wealth works in our economy. Because the reality is that there's a critical difference between wealth and money that changes everything about how finances work at each level. And understanding this distinction isn't just academic, it's the key insight that separates successful investors from everyone else. When we're talking about someone being worth billions, we're not talking about what's in their checking account. We're talking about what they own. Wealth primarily exists in ownership stakes in businesses, real estate, investments, and other assets that have value. These assets represent claims on future economic production, not actual cash. Think of it like this. Imagine you have a house worth $500,000 and you have some cash, $5,000 in your bank account. Your wealth, your net worth, is now $505,000, but your cash is only $5,000. The house has value, but you can't use it to buy groceries without converting it first. If we take Elon Musk as an example again, most of his wealth is tied up in Tesla and SpaceX stock. If Tesla's stock price goes up 10% in a day, for example, headlines might say Elon Musk made $20 billion in a day. But nothing actually happened in his bank account. He simply owns the same assets that other people suddenly trade for a higher price. This is why billionaires often take out loans instead of selling their assets. In 2021, we learned that Larry Ellison, the co-founder of Oracle, had a $10 billion credit line backed by his stock. But why would you even borrow money when you're worth billions? Because converting wealth into money has consequences, which is what I'll explain next. Understanding that cash is value or ownership rather than cash explains seemingly contradictory events like billionaires facing cash crunches or taking out loans. It's not that they're lying about their wealth, it's that wealth and money function differently in our economy, and this distinction founds the foundation of sophisticated financial planning on all levels. Here's something mind-blowing. The wealthier you are, the harder it becomes to convert that wealth into money without destroying its value. And this is what I call the liquidity paradox. Imagine you own 50% in a company that's worth $10 billion, making your stake worth $5 billion. But if you try to sell all your shares at once, you'd crash the stock price. You might only get $2 or $3 billion, instantly evaporating billions of dollars in wealth. And this isn't at all hypothetical. It happens constantly. This is because the stock's price is also based on supply and demand, just like everything else in the world. If supply suddenly goes up but demand stays the same, prices fall. Jeff Bezos, for example, also doesn't sell Amazon stock all at once. He typically announces that a couple of months before, and he also typically limits it to about $1 billion per year, which is still a tiny fraction of his total wealth. When large shareholders dump stock unexpectedly, markets do panic. In 2022, for example, when Mark Zuckerberg's selling of Meta stock accelerated, Meta's stock price suffered partly because of these signals. And often more tellingly, when billionaires need significant cash quickly, they don't sell their assets, they usually borrow against them. This preserves their ownership in their company while also accessing the cash. This strategy, sometimes called buy, borrow, die, lets them maintain control of appreciating assets while funding their lifestyle with loans. This liquidity paradox explains why billionaires' wealth is somewhat real and somewhat illusory. Yes, their assets do have value, but that value only exists within a system that depends on them not trying to convert too much wealth into money too quickly. This creates a strange reality where the ultra-wealthy have vast resources but face unique constraints on using them, because if they try to use them, they lose a big part of it. You've probably seen these viral TikTok posts, like Mark Zuckerberg earns $43,000 per minute, or Elon Musk makes $375 million in a day. These calculations take yearly changes in net worth and divide them by hours, minutes, days, and so on. And while this is a fun thing to think about, this fundamentally misrepresents how wealth actually works. When Meta's stock price, for example, increases 5% in a day, Zuckerberg's ownership stake, of course, also increases in value. But this isn't earnings in any meaningful sense. He didn't receive a deposit, no transaction occurred, and crucially, these earnings can vanish just as quickly as they appeared. Consider what happened to many tech billionaires in 2022. The same calculations that showed them earning astronomical amounts in 2021 would now show them losing millions in 2022. In fact, Meta's stock price fell over 70% in 2022, wiping out more than $70 billion of Zuckerberg's net worth on paper. So if we were to apply this earnings per second logic consistently, we'd now have to say that Zuckerberg was losing millions of dollars per hour for months. But that's just as misleading as saying he was earning them in the first place. This mischaracterization matters because it distorts public understanding. It suggests that billionaires are receiving constant massive cash flows rather than experiencing fluctuation in theoretical value of assets they own. This creates skewed perceptions of what wealth actually is and how financial systems operate. When we understand that these aren't earnings but valuation changes of existing assets, we gain a much more accurate picture of economic reality. Of course, it's not like billionaires don't benefit from their wealth, they absolutely do, but the mechanism and the reality of what they can do with this wealth is completely different from what this calculation suggests. When inflation strikes, dollars sitting in your bank account lose purchasing power. If inflation is 8%, for example, $100,000 sitting in cash effectively becomes around $92,000 in real purchasing power over a year. This is why holding large amounts of cash during high inflation periods is a poor strategy. However, wealth in the form of ownership often behaves differently. Companies can raise prices during inflation, real estate prices often increase with inflation, and commodities like gold may maintain or also increase their value over time. So while inflation destroys money's value, many forms of wealth can preserve or even increase their value during inflationary periods. During the high inflation of 2021 and 2022, people holding cash saw their purchasing power erode dramatically. Meanwhile, real estate owners in many markets saw their properties appreciate at rates that matched or exceeded inflation, and business owners could often pass increased costs to customers. This is why financially sophisticated people rarely hold much wealth as cash. Warren Buffett has repeatedly called cash a terrible long-term asset that people go crazy over. Instead, he focuses on owning businesses that can adapt to changing economic conditions and maintain their real value over time. This different response to inflation reveals another critical distinction between wealth and money. Money is static, while wealth is adaptive. Ownership in productive assets gives you a stake in systems that can respond to changing conditions. This dynamic quality makes wealth fundamentally more resilient than actual money, which is why building wealth rather than just accumulating money is essential for long-term financial security. Our tax systems fundamentally treat wealth and income or money differently. Income, which is money coming to your bank account, is taxed immediately at rates up to over 50% in some countries, whereas increases in wealth through appreciation of assets in value aren't taxed at all until those assets are converted into money. This creates an extraordinary difference in growth trajectories. If you earn $100,000 in income, you might keep around $65,000 after taxes. If your assets appreciate by $100,000, you keep the full $100,000 in assets until you finally sell, potentially decades later. That's because taxes are always paid in form of money. You can't give half your house to the government. And if you had to pay money to the government for the house appreciating in value, you most likely would have to sell the entire house to be able to pay the taxes. But then the question is, do you get money back when the house shrinks in value? You see, it's not that simple. But this system explains why you rarely see wealthy individuals with high salaries. Elon Musk's Tesla salary was officially $0 for many years. Instead, he received stock options that allowed his wealth to grow without immediate taxation. Similarly, founders like Mark Zuckerberg or Larry Page primarily hold their wealth in company stock rather than taking large cash distributions. When they need money, they can borrow against their holdings, which is not taxable, instead of selling their assets, which would trigger capital gains tax. So the distinction between wealth and money isn't just semantic, it reveals how financial systems actually operate on every level of society. Billionaires aren't sitting on mountains of cash, they're juggling ownerships that represent theoretical value within restraints of liquidity, market psychology, inflation, and tax optimization. So we've learned that wealth is primarily ownership, not cash in bank accounts. The liquidity paradox means you can't easily convert unlimited wealth to money. Earnings per second calculations for billionaires misrepresent how wealth actually works. Wealth can resist inflation while cash deteriorates, and tax systems create powerful incentives to build wealth rather than accumulate money. So the next time you hear about a billionaire's net worth or see headlines someone making billions of money per day, you now understand what's really happening beneath the surface. You're seeing changes of perceived value of what they own, not actual deposits into their bank account. So thank you very much for watching, and I hope to see you in the next video.